Over the next few minutes, I'm going to take you through exactly how to build a DCF model without overcomplicating it. There's 5 simple steps we need to go through. A lot of people stumble on this, but we're going to keep it nice and simple. So first of all, what is a DCF model? DCF model is a way to answer one simple question. What is the business worth today? And we do this by estimating the future cash flows over the next few years and bringing them back to today's dollars. So the reason why we focus on free cash flow is that you can have a look at revenue, EBITDA, gross profit, all those other accounting principles, but they can be distorted. Whereas we only care about what cash is hitting the bank. And so we use free cash flow or unlevered free cash flow to be specific for a DCF model. So now we're going to go through the 5 steps that it takes to build out the DCF model. And then at the end, I'm going to go through and show you exactly how to do that using an Excel template that you can download as well. First, we need to forecast out our free cash flows. So typically we look at a 5 to 10 year period here, and we need to make some assumptions to forecast. So we need to make assumptions around the growth rate, the margins, the reinvestment, and how the business actually works to understand what the cash flows might look like over the next few years. So once we've forecasted out the financials, we then need to take those financials and turn that into free cash flow. And so it doesn't matter whether you start with EBITDA or start with net profit after tax, there's a couple of adjustments you need to make. So if you're starting with EBITDA, you need to subtract your tax, capital expenditures, and increase in non-cash working capital. So working capital there is your increase or decrease in accounts receivable and accounts payable. They're items where you haven't received the cash there. So you may not have paid the bills for your rent, for example, or you might not have collected any invoices for the services you're providing. And so all of that is non-cash items. So that is from the EBITDA. If you take away the taxes, capital expenditures, and increases in working capital, that will get you to your unlevered free cash flow. Then on the other side, if we start with net profit after tax, we need to add in interest, depreciation, and amortization. And then we need to subtract capital expenditures and the increase in non-cash working capital. So I've mentioned unlevered free cash flows there. What is the difference between unlevered and levered? It is simply the debt side of things. So what is the cost of the capital structure that the business is using today? We want to consider the business as if it has no debt, because when you're acquiring it, you may change the way that you structure the financing for that business. And so we don't want to have that flowing through the financials. So everything we do in the DCF model is using unlevered cash flows, which is why we haven't considered interest in either of these formulas here. The next step is to determine the terminal value. So when we forecast out the free cash flows, whether it's 5 years or 10 years, we are understanding and discounting those cash flows to today's dollars. But in doing that, we're only valuing those periods. So let's say we take a 5-year time horizon. We are valuing those cash flows for the next 5 years. But then in doing that, we haven't considered that it'll continue to generate cash flows beyond those 5 years. And so that's what the terminal value does. It captures all the value that happens after the forecast period. So how do we calculate the terminal value? There are 2 methods used to get to that terminal value. So one is the academic side of things, and one is more what's used by industry. So the perpetual growth method, we'll start there. This is used by academics. This is what you'll find in textbooks. This is what you learn at university. In practice, it's not used that often. So what this formula is here, we've got the free cash flows on the terminal period. We times that by 1 plus the perpetual growth rate of free cash flows. So basically what we're expecting the business to continue to grow into infinity. Then we need to divide this by WACC minus that same perpetual growth rate. That'll get us to our terminal value. The simpler method, and the method that's more commonly used in industry, is taking the exit multiple method. So essentially we have a financial metric and we times that by a trading multiple. So when you get to the terminal value, usually it's a multiple of EBITDA. It may be a multiple of revenue if it is a high growth tech startup. but I won't get into that in this video. So for this one, we assume that it is EBITDA, and we assume that there is a 10x multiple there. So if we multiply EBITDA at the terminal value or the terminal period, we multiply that EBITDA by 10, and then we discount that back to today's dollars. And that's how we get to the terminal value for the exit multiple method. So I've mentioned a couple of times that we're using a discounted cash flow and not just free cash flow. So everything so far, we've really just talked about free cash flows and why that's important. We actually need to bring that back to today's value. So when you think about $1 today, it is worth a lot less than $1.50 years ago. Even in your lifetime, like you would have seen that the dollar is less valuable and not able to buy as much over that period. So we need to consider that going forward. Although we know that the business is going to continue to grow into the future, that growth is offset by inflation. And so we need to make sure that we consider that in our cash flows. So how do we do that? The way we discount all future cash flows is using the weighted average cost of capital, commonly known as WACC. So the WACC is, it looks quite complicated with the formula there in front of you, but realistically, it's quite simple. It is the cost of your equity and the cost of your debt weighted for how much is used to fund the business. The debt side of things is relatively simple. That's the second part of this equation here. We've got the ratio there, so the debt over the total value. So that's the D over V. Then we've got the cost of debt there. So we times those together, just ignoring the second component of this formula for the moment. So that first component is the proportion of debt times the cost of debt. And cost of debt is just simply the interest rate that's charged by the bank. Then we've got that second component there, and that's 1 minus T. That's 1 minus the tax rate. The reason we need to consider this is that when you take on debt, those interest repayments are tax deductible, and therefore we need to consider that in the cost there. So we've got the weighting there at the front end times the cost, and then we need to consider the tax on the back end. So that is the debt proportion. The equity proportion is the front side. I'm going to go through the simple component here of the equity side of things, and then I'll show you how to actually calculate the cost of equity. So here we just simply have basically the proportion there, so the E on V, and then we have that times by the cost of equity. So the cost of debt's quite simple. It's the interest rate charged by the bank. The cost of equity is a little bit more challenging. So the cost of equity, we do have a formula for that one. It's called the CAPM, which represents the capital asset pricing model. So what the CAPM is first we've got the expected return, which is the anticipated return on an investment. We've got the risk-free rate there, which is the theoretical return of an investment with zero risk. Usually we use like a 10-year treasury bond there. Then we've got beta, a measure of an asset's risk. So basically the volatility of the asset compared to the overall market. And then we've got the risk premium there as well. So that's the delta between the expected return and the risk-free assets. The components we have there, we use that in the formula that calculates the expected return on an asset based on its risk relative to the market. So that formula there, we have the expected return equals the risk-free rate plus beta times your market risk premium. So it defines the cost of equity by summing the risk-free rate and the product of the assets beta and the market risk premium. So we'll take a look at this when we get to the model and when we're going to go through that template that we've provided you. We'll show you what that looks like. A lot of the time when you're in an interview, you'll receive all those assumptions. So each of those components, you'll receive that number, except for the market risk premium. You'll need to calculate that yourself, but you'll be provided with the rest. And so then you'll need to take those to turn that into the cost of equity. If you've got a more simple modeling assessment there, you might be given the cost of equity without having to calculate it. But let's just assume that you're going to have to calculate it. So the next step is step 4, which is summing the present values. So we've got those estimated future cash flows. We've got the discount rate, which is the WACC Now we need to apply those two together to get to today's dollars that we've estimated there. So it's pretty simple. As we go through it, we have a factor there that we apply to those cash flows. You'll see how that works in practice when we go through the model, but we're simply timesing those two together to get to what it looks like today. You'll see that as we go further and further out into the future, that discount rate starts to have a pretty big impact on the cash flows. So that WACC is really important. And that's why we typically don't forecast out further past 5 to 10 years, because beyond that, it's discounted so much that it doesn't have a material impact on the valuation itself. So you'll see how that plays out in practice, but that's the next step, is just that we need to discount those cash flows. Once we've got those cash flows all discounted and brought back to today's value, when we sum all those up, we get to the enterprise value. We then need to take that enterprise value and turn that into the equity value. So the value of the business without any debt or cash. So when you think about the enterprise value, the value of all those future cash flows, they're not just for the equity owners. They're not just for the shareholders of the business. There are the banks that also have an interest in the business through the debt lending that they've provided. And so we need to consider that when valuing the equity value of the business. So we just make some simple adjustments there. I'm going to show you what it looks like using a house as an example, just so you can understand the difference between an enterprise and an equity value. So having a look at this one here, we have the enterprise value plus cash minus debt, and then net working capital surplus deficit. So we've got a surplus in this one here. We've just thrown in some numbers there just to visualize it all. So enterprise value of $1,000, we add 100, we take away 150 for the debt, and then 25 there for the net working surplus, which gives us to 975 equity value. Still doesn't really show us what the difference is or why it's important. So let's use an example of a house. We've got the same numbers here for a house. As you can see, I've taken away net working capital there. There's only the two adjustments. I'll talk through the net working capital, but I thought it might complicate things a little bit. So I've just taken that one out for the moment. So pretending that the house is valued at $1,000, within that house, we then have a safe. In that safe, there's $100 there. So if I'm looking to buy that house, I would need to pay an extra $100 because there's $100 sitting there in the safe. So that increases the valuation of it by $100. But then also the person that owns the house, they have a loan to the bank. So they owe the bank $150. They've actually paid off quite a bit of their loan there. So they've only got $150 left. So when we pay that $1,100 to include the cash that's in the safe, the person that's receiving that isn't receiving all of it because $150 of that needs to go to the bank. And so we take that away there, and that gets us down to, it should be $950, but I've left it at $975 to include the net working capital adjustment in the previous slide here. So that's the cash and the debt side of things. That's why that's important. The equity value is the value to the owner of the house. And you can see how there's a few adjustments there that change the valuation there based on the enterprise value to the value that they actually receive. The net working capital, so what that would be in this case here would be any outgoings or anything that's owed by the owners of the house. So if you think about maybe they've had a plumber come in and fix up some things and they've got some bills there that they need to pay, that would be a net working capital deficit. A net working capital surplus would be if it's an investment property and they've got some rent outstanding there. So their tenants haven't paid all their rent yet. They can collect that cash and that is cash to them. And so that's a surplus. So in this example here, let's pretend that they've got that $25 there that's owing in rent from tenants. They would then collect that, and that brings it up from the $950 to the $975 value there. So they're the different adjustments we need to make to take it from the enterprise value to the equity value. So they're the 5 steps. It seems pretty simple now. So what we're going to do is put that in practice and run through the templated DCF model. So we've provided that to you. You can follow along. You can attempt it first yourself, attack it any way you want. My suggestion is if you're not feeling super confident on being able to put it together, just follow along with the videos and do it at the same time as us. So I'll run through that now. We'll open up the Excel model. Okay, so now we've got a templated model here that we're going to go through. I've given you some assumptions. I've filled out some of the discounted cash flow. They might not be so generous in an interview. They might not give you this layout. So utilize this in the future as you're working through those models. If you do want to skip ahead and check that you're doing things right, you can look at the complete tab there, which has everything filled out. Everything that's been filled out is bolded. So like this one here, we've got the cost of equity. We can see that over here, cost of equity is empty. So I've just bolded that one there for you then. We need to go through and fill in all these yellow squares, which will then flow through and update these graphs at the top here. What we're looking for is the terminal value, and we'll see the market value versus the intrinsic value. The intrinsic value being the valuation we come to from the DCF model, the market value being the current share price today. So remembering that the share price for a public company doesn't mean that it aligns with the intrinsic value of the cash flows expected to be generated in the future. So let's start working through this. First, we've got the discount rate. So we need to work out the WACC, which is the weighted average cost of capital. We have the cost of debt here at 10%. We need to work out the cost of equity, and then we need to work out the ratios. So I'm going to start with something simple and go the ratios and get back to the cost of equity there. So the ratios, we are simply going the debt. So in this case, we've got D on top of D plus E. So the debt is up here. We want to put that on top of the equity and the debt. So very small. Then we want to do the same thing for equity, which is just the reverse. So we put the equity on top of the sum of the equity and the debt. And so those two should always sum to 1. So we've got our ratios. We've got our cost of debt. Now we need our cost of equity. So remembering how to calculate the cost of equity, I've got the formula on the screen there. We start with the risk-free rate, which is commonly the 10-year Treasury bond rate. We then plus the beta times the expected market risk premium, which is the delta between the risk-free rate and the expected market return. So let's calculate that. So we've got the risk-free rate plus we've got the beta times the delta between the market return and the risk-free rate. And that gets us to 12.6%. You can see I've got that in black there because that is a formula that we've calculated. So now we have our cost of debt, we have our cost of equity, and we have the ratios there. And so to calculate the WACC, the weighted average cost of capital, which is also known as the discount rate, we literally just need to weight those there. So we've got the equity times its weighting, 0.97, plus we've got the debt of 10% times its tiny weighting of 0.03. And so we get to, let's bring that out, 12.5%. So just going to pause the video here. When I was going through this the first time around, we didn't capture the impact of the taxes on the cost of debt. And so this formula is slightly wrong. We do correct this later in the video, but if you want to take the time now just to think about how you would change this formula to get to the right cost of debt, do that now just to get that practice in. Okay, back to the video. That there, see it's in blue, it's a formula. Let's make that black, done. Okay, so that's our discount rate. Now we've got how we're going to discount the cash flows. We need to estimate those cash flows going forward. So scroll down to the discounted cash flow section here. We've got a few assumptions already in there. We've started with the EBIT. We need to consider what the cash taxes are. So up here, we have the tax rate. We've assumed 30% there. So simply assuming that it's that times 30%. So I want to make that a minus in my formula. And I want to fix that times in of the tax. Let's bring that across. So now you can see that it's 30% of the EBIT there. So that brings us to depreciation and amortization. We're adding that one back in there. Then we need to take out the CapEx. So CapEx is an assumption we've made here. In real life, that CapEx would grow with the business, and it might be an assumption based on the revenue or the profit of the business going forward. But in this case here, they've just used a standard $15,000 to over across the full period. So we're just going to bring that one down. Let's fix that one, and then we can drag it across. Again, we want to make it less. So let's fix that up. Then we've got the changes in net working capital. So as you can see in this one here, it fluctuates a bit over the periods. But as you can see, it's always positive, which means that they're always collecting more than is going into the net working capital. So just thinking about receivables, if we're increasing the cash flow here, it means that we're collecting more receivables from the previous year than we have put into receivables in the current year. Now, we obviously need to consider the payables there as well, but just kind of allowing you to visualize what's happening there in the balance sheet. And so now we just simply need to sum those to get to our unlevered free cash flow. Now we've got our unlevered free cash flow here. What is the difference between levered and unlevered? It's all around interest. So as you can see here, we've got earnings before interest and tax. So interest isn't included in there. If we had interest in there, that would decrease. This cash flow would decrease because there'd be that interest expense to the bank. And so that would be the levered free cash flow. As I said at the start of the video, we need to use unlevered, and that's what we've got here. Now we've got our forecasted free cash flows. Now we need to consider that these are to be discounted to today's value. The way this discount factor is, we simply go equals 1 divided by 1 plus the discount rate, which we've got up here of 12.5%. And then we need to the power of the periods that we've got here. So the periods here actually should be, so you see these time periods, they're not quite right. I want to have them as starting with that there. So now if we increase the decimal places, we can see we've got the half periods there and it flows the whole way through. Discount factor should decrease there over time. So with the time periods there, what we're showing there is that first period here is only half a year of discounting. And so we don't want to fully discount that 12.5%. And as you can see, half of that is roughly 6%. And there we've got roughly 6% off the one. So as we start to take that out, we want to leave that to flow through, but we do want to fix the discount rate so that carries across. So let's bring that one across. And then on the exit value here, we see we've got the dates are the same. So let's just bring that one across as well. So it's that. So now we've got our discount factor. Simply what that shows is the decrease in what $1 today is worth in the future. So in 6 months' time, $1 today would be worth 94 cents and so on as you go out. So then we need to multiply the cash flow in that period by how it'll be worth less today. So that $16,927 at the end of June in 2026 would be worth the $15,961 in 31st of December. Let's apply that out. So as you can see, I haven't filled in this exit yet. I need to get to this terminal value section first, but I'm just filling this in. So when we've done that, it'll all flow through. This entry exit here, it is based on the average here. So now we've got the discounted cash flows there. We've got the intrinsic value, which I'll calculate out, but I think that it's probably best now to move on to the terminal value so that we can get this final value here. We can see the discounted terminal value, and then that'll give us our full final enterprise value. So as I went through at the start of the video, we have two methods to calculate the terminal value. We've got the perpetual growth method and we've got the multiples method. What I'm going to do in this case is I'm going to go through both of them and I'm going to take the average for the terminal value. In practice, that's not really used that often, but it gives you a view of how each of these methods is done. And then you can decide which one you want to use. So the multiples method, very simple in how we do that. We literally just apply that EBITDA by the assumed 7x multiple here. In practice, you might need to find out what multiple to apply it by, and that is typically done by comparing it to other businesses that are quite similar. So in this case, we've been given that 7x, so we're going to use it. What we don't have at the moment is EBITDA. So we've got EBIT here, we've got the depreciation and amortization, so we just need to add those two together. So first we'll go add those two together on the terminal value there. So that plus that one there, and then times that by the multiple. So 546. Then we need to do the perpetual growth. That one is a little bit more complicated. I'll put the formula on the screen. So the perpetual growth rate, we need to start with the unlevered free cash flow. So let's grab that one at the terminal value period. We then need to multiply that by 1 plus the growth rate to show that it's growing into perpetuity. Then we need to divide that by the difference between the discount rate and the perpetual growth rate. Cool. What happens if we increase the discount rate? Let's just move that off of there so that we can play around with it without it messing anything else up. Put it there. And so we've got 12.5% there. That gets to our 455. What if we make that 14? Comes down. 16 comes down even further. And if we go to 10, it goes way up. So the closer the discount rate and the perpetual growth rate, the higher the perpetual growth terminal value will be. So let's fix that one back out. Up there. Cool. Then we just take the average of those two. So now we've got our 501. We discounted it. It's automatically flowed through there because we set that up before. Then we need to take our enterprise value, which is just the sum of all these items here. So just here, I'm updating the discount rate to consider tax, which was a mistake from me. So we've got our enterprise value there of 427,900. Then we need to take it from the enterprise value down to the equity value, remembering the example of the house there. The enterprise value is the valuation of the house, but then thinking that the owner of the house doesn't receive all of that because they potentially have a safe in there with some cash, but they also likely have a loan there to the bank as well. And so we need to make adjustments for that. So these assumptions are up the top. Pretty simple, plus the cash, less the debt. And that takes us to our equity value. Then we need to take the equity value per share, just so we can compare it to the share price today. We've got the shares outstanding there. So we've got 20.73. As we can see up here, the current price is 16. So these are filled out, or the upside and the intrinsics filled out. We need to see what's happening with the market value, which is figuring out this one here. So market cap today is simply the shares outstanding times the current price, then plus the debt to the opposite to get it to the enterprise value. So plus the debt minus the cash. So just be careful with this one because this is the opposite of what we've done here. We've done plus cash, we've done plus debt here. The reason is the market cap is the equity value, and so we're doing the reverse to get it up to the enterprise value. So the equity value per share, we've got the equity value, which would just be the same as the price up here. Equity value by the shares outstanding. So 16 there. And then that flows up here and you can see market value as it is today, $16 a share. There's upside of $4.73. So the intrinsic value, the value of the cash flows to the business today is worth $20.73 per share in the business. And that is simply how you put everything together in this cash flow model. So the most challenging parts for this for most people are understanding how to calculate the WACC. So this discount rate here. As you can see, I made an error at the start of the video in that I didn't consider the tax discount there, rushing through it. That's a common mistake. Make sure you don't make that mistake there as well. and then also doing the perpetual growth rate. Once you understand those formulas and you remember that, it's not too complicated, but just take some time to really practice that and go through it all. So as you can see, we've got the exact same thing as the complete model here. This is just formatted slightly differently because I don't have all those yellow boxes, but they're all the same numbers. And so if you go through that same exercise now, if you didn't follow along, go through it now and practice that. It's a really easy way to see how to build out a DCF model. The next complicated part that you need to learn, which we'll address in a later video, is actually getting to this EBITDA and forecasting that out. So that was given to you as part of this video because we just want to show you the basics of building a DCF model. But in practice, you will likely need to forecast that EBIT yourself as well. So I hope that was helpful. I hope you took a lot out of that video. I hope you now understand how to build a DCF model quickly. It only takes a couple minutes to put it all together once you have the assumptions in place. So hopefully you've learned a lot from that. If you do have any questions, feel free to reach out. But otherwise, I'll see you in my next video.